Today we're going to be talking about the difference between APR and interest rates. If you don't know, this is a real hot topic with most people and something I'm usually getting calls about. It's confusing whenever you're getting a loan and not understanding what it means. When you're looking at an investment, the interest rate is just one element. It's often not a 100% accurate idea of how much you're saving or how much you'll pay. That's really essentially the difference between the two. We'll be going over this in more detail in this video. So interest rates are the rate that you pay back a loan. So let's say you borrow $100,000 from the bank. They're charging you 5%, which is the interest rate for loans of $100,000 from their company. Now, depending on how long a term is, how much a loan will cost depends on the APR. The APR is the actual cost of getting said home or vehicle financing for X number of years. Interest rates are important, but when considering the total cost of a financial investment, you also need to consider APRs. Interest rates are only one of many factors that influence how much money you'll ultimately pay. But there will be times when consumers get confused with this because these rates are on most of the same documents as your principal. So, your interest rates will affect your monthly payment, plus there are also one-time fees that come along with getting a loan. However, most loans are for a set term of years and mortgage insurance does not usually last the whole time period. APR can vary depending on what other integrations are included as well. It may include things like processing, underwriting, title and interest rate buy down, or if insurance or home loans are being bundled. So what does it actually cost you to get financing? Now some people get confused because there are those fees associated with acquiring the asset. So in real estate that would be property tax or homeowner's insurance, and those things are not included in finance charges because they have nothing to do with the home loan itself. It has to do with acquiring the real estate property. It's very similar in all other things. If it's about acquiring an asset, it won't typically be included in the annual percentage rates. Things that can impact interest rates are whether or not something is fixed or not. It's a whole lot easier, I will tell you, to calculate an APR on a fixed rate whatever versus a variable, because variable rate mortgages will go up depending on whatever index they're attached to. Okay, so when you think of interest, you think of your monthly payments. When you think of APR, think of total costs. Now for me, I always think that the best course of action is to get an itemization of what you're paying to get said financing, so that you really have a comprehensive overview of what you're paying. And it's also very important to note that these finance charges are included in your APR. Regardless of whether or not they're paid outside your closing, whether they're paid by the seller, whether they're paid by your lender or your real estate agent. These APR items do not change because they're the same regardless of who pays for them. So just know that an APR may always be the accurate picture of what you pay. Just an accurate picture of what it costs to get said look. So I hope today was very valuable on explaining the differences between interest rates and APRs.